Good afternoon and welcome back everyone to another episode of our Thursday options education session. And today we're going to be talking about a topic that is incredibly popular and many of you have been asking for, which is trading 0 days to expiration options strategies. Now, for those of you that have been joining us for the last few weeks, you know that we are continuing to move down the curve in structure. And we started talking about option income strategies. Then we started talking about weekly options, so going shorter dated. And today we're going to the very extreme end of the curve of trading 0 days to expiration options. And today will serve as a bit of a foundational course to help you get started. We're not going to be able to cover everything with regards to 0 days to expiration, but if many of you are looking for this type of content or looking for more information, we will take that as a signal to do more of this as well. So let's go ahead and get started. And just a reminder for those of you that are joining us for the first time, OptionsPlay education sessions hosted every single Thursday at 4:15 p.m. is catered to help all of you, empower you to trade sustainably and confidently, and make sure that you have a well-rounded education for your options trading and technical analysis knowledge so that you can feel confident in your abilities to grow your account sustainably in the long run. Now, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. So what we're going to cover is, like I said, a bit of a foundational understanding of 0 days expiration options. So the first thing what we want to start off with is understanding the Greeks. What's different about 0 days expiration than all the other options expirations? Because that's really going to help define how you think about trading these types of options and what type of strategies make sense when you're trading really short dated options. Then we'll talk a little bit about the difference between trading ETF versus index options when we're talking about 0 days to expiration or daily options. Then we'll talk a little bit about the intraday trading setups. It's a completely different mentality to trade these really short dated options versus longer dated options. So we'll talk about how you have to shift your mentality and what you have to look for in terms of indicators. Then we'll dive into the top 3 option strategies for 0 days to expiration. We're going to talk about I wouldn't necessarily say from beginner to advanced, but from what you will trade most commonly to what is kind of more advanced strategies, kind of giving you a pretty wide spectrum of the different types of strategies that you might deploy trading 0 days to expiration. We'll talk about the strategy best practices for each one for entry and exit before we open this up for Q&A. And each one of these, I will go through an example for you to help you better understand it. But my goal here for today is to provide you with a foundational knowledge to at least get started with trading 0 days to expiration options. And we're going to cover primary 2 things: the foundational knowledge. How do 0 days to expiration options differ from options that are longer dated? That's an extremely important element to understand before you venture into trading shorter dated options. And then the second part is the option strategies. What are the most popular strategies to trade 0 days to expiration, and what are their best practices? Those are the primary things we're going to cover during today's session. Now, for those of you that are joining us for the first time, please, as you can see, the chat windows are very active. Please feel free to chime in, tell us, say hi into the chat windows, tell us where you're from. Many of you that have been joining us for many weeks have already done so in the chat windows, but if you're joining us for the first time, please feel free to chime in. As you can see, there are hundreds of you from all over the world, and making sure that you have access to a community and the right education and tools to help you leverage the type of strategies that we're going to discuss during today's session. Now, a common question, especially for those of you that are joining us for the first time, is how do you get access to the recording and the slides? Both the recording and the slides will be available after each session, especially if you have a free trial or a membership. You'll be able to get an email communication from us when we upload those recordings, and you can sign up for that free trial by pointing your phone to that QR code on your screen, or Philip will deposit a link into the chat window for you to sign up, which is optionsplay.com/free sign up. That will allow you to get access to both the recording and the slides and the tools that I'll be showing you during today's session to analyze and trade some of these strategies in your portfolio. So let's go ahead and get started. And we're going to start off by better understanding the option Greek. Specifically, what is the primary difference between trading shorter dated options and longer dated options? So the first one to understand is time decay. Options, the value of an option, the extrinsic value of an option erodes to zero as you approach expiration. Now, that erosion does not happen in a linear scale. It accelerates as you get closer and closer to expiration, which is, from an academic and theoretical perspective, why 0 days to expiration favors option sellers, because you get the fastest erosion in that final day of expiration. You actually get the fastest erosion in the final 2.5 hours within the intraday. So if you think about the extrinsic value of an option, it actually erodes almost half of it in the last 2 hours of trading. So if you sold an option, at the open, you would expect about half of the extrinsic value to erode in the first roughly 4.5 hours of trading, and the other half will erode the final 2 hours. So you really get this acceleration on steroids. However, it's important to understand that the acceleration approaches infinity as you get closer and closer to expiration, but because they're already so short dated, the total premium that you're collecting is incredibly small. And it's important to understand to quantify how small that or how little income you are collecting. So what we did is we did some comparison of 0 days to expiration extrinsic values versus 45 days options extrinsic values to get a sense for just how much income are you collecting on a 0 days expiration versus a 45-day expiration, which is our typical expiration cycle when we're looking at cover calls, credit spreads, iron condors, those types of option selling strategies. When we're doing longer dated options, we usually go out about 45 days. So we did some comparisons, and what you find is that 0 days expiration, you collect about 1/8 of the premium that you would typically get on a 45-day option. So obviously, if you were able to collect that premium every single day, in 45 days, there is about 30 plus trading days in that 45 days to expiration. If you were to do that every single day, if you collect 1/8 of the premium, you obviously would come out ahead with regards to the amount of premium that you would collect. But keep in mind that you have to do it 30 something times, which means that you have 30 something times the transaction cost. You have 30 something times the expiration and exercise risks that you have to deal with. Those are 30 plus chances of being assigned on the underlying shares. So it's not, in my opinion, just a great comparison to say, oh, if I just sold 0 days to expiration 30 days in a row versus selling one 45-day option, I'm definitely going to come out ahead. There's a lot more complexity with trading 0 days to expiration every single day. But just to help you quantify how much income you receive, roughly 1/8 of the premium that you would collect if you were to sell a 45-day option. So selling short dated options, you simply get more income per day, but it comes with higher amounts of risk, and it comes with substantially higher transaction costs. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Okay. Now, time decay is the one that most, I would say, traders, especially for those of you that are either starting out or have a little bit of experience, are focused on when you're thinking about shorter dated options. You're thinking about the acceleration in time decay. But one of the Greeks that most traders may not be top of mind, that's actually, in my opinion, more important is gamma. Gamma measures the change in delta with respect to changes in the underlying. So delta tells you how much leverage your option receives, and gamma basically changes delta based on the underlying changes. And what happens is that 0 days to expiration options are extremely sensitive to even small changes in the underlying. So your deltas can go from 10 deltas to 90 deltas within just a small swing in the underlying position, meaning you can either get a lot of leverage or decrease significant decreases in leverage, basically very large swings in the value of your option based on a very small underlying change of the underlying stock or ETF. So how much leverage is there? We also did the same comparison, trying to compare 0 days to expiration to going out 45 days. So if you were to buy a call option that expires today versus an option that expires 45 days out, the difference in terms of leverage is about 10x. That means that if you were to buy a 1-day option versus a 45-day option, and let's say the market moved up 1%, the 0 days to expiration option may have received 100% gain on that 1% move in the underlying, versus the 45-day option would have gotten a 10% move or 10% gain on that underlying on your option. So when you're trading 0 days to expiration options, you have huge amounts of leverage, 10 times the amount of leverage that you would typically get if you were trading a 45-day option. So buying shorter dated options has the potential for huge gains if you get the directional and magnitude views correct, meaning this is really what a lot of traders kind of get attracted to when you're thinking about 0 days to expiration. You may have seen YouTube videos or people claiming how they've made 500, 1,000% gains in a single day. It's usually on these types of 0 days to expiration options where they're buying an out of the money option. The underlying makes a big move, and that goes from, a 50-cent option to a $5 option, 1,000% gain on their investment. We're going to talk a little bit about this. We're going to talk about kind of what type of markets you might want to trade these types of strategies on. But like I said, first, we must understand the fundamental differences between the strategies. If that makes sense to you, please type 2 in the chat window if that makes sense to you. And I see a couple of questions about assignment risk, and we're going to get to that here in 1 second. So trading 0 days to expiration, you really have 2 choices. You can trade index options and you can trade ETF options. And we're going to talk about both first, then we'll talk about the difference between the 2. And we'll first talk about why, if you're trading 0 days to expiration, you really have to only trade indices or ETFs. First of all, indices and ETFs diversify away single stock risk. And this, generally speaking, is a positive for any option selling strategies because you avoid, gap risk, you avoid any type of single stock risk. You're basically diversifying all of that away. You don't have earnings, you don't have catalysts, you don't have anything like that can, news-driven events that will drive a particular stock, up 5 to 10% in the intraday. You just don't get that in indices. As an option seller, that's favorable. As an option buyer, you obviously do sometimes want that volatility, but this is something we'll talk about here as we dive into some of the details of trading intraday options. The second thing is that indices rally about 60% of instances, and this just puts statistics in your favor. If you're selling option strategies or if you're buying option strategies, knowing that there's a statistical tilt in one direction certainly helps with choosing a directional view, and we'll talk a little bit about that in terms of back testing of selling puts versus selling calls and kind of what the performance of those strategies look like for these types of 0 days to expiration. But probably more importantly than anything else is the deeper liquidity and the daily expirations. At this point, single stocks don't offer daily expirations, only ETFs and index options, specifically the most widely traded ETFs, SPY, QQQ, IWM, GLD. These are the types of stocks that offer daily expirations, and the corresponding index options for those major indices also offer daily expirations. They offer very, very tight bid-ask spreads. You can basically trade them super liquid at the midpoint pretty much all day long, even as you enter the close at the beginning of the day. So you generally have very low transaction costs trading these because obviously when you're trading intraday, you do need the ability to get in and out very quickly with virtually 0 transaction costs in order for these strategies to be effective. And only these products offer those types of characteristics. Does that make sense, everyone? Please type 3 if that makes sense to you. Perfect. Okay, let's talk a little about the difference between ETF versus index options. Now, from my perspective, if it wasn't for the size of index option contracts, I would certainly favor index options for these types of strategies because they're cash settled. They're easier to hold into expirations. You don't have to worry about assignment risk, early, exercise risk. You don't have to worry about needing cash in order to, if something was auto exercised, whatever P&L you get at the end of the day, you can hold into expiration and the P&L will simply be accredited or debited into your trading account. So extremely clean for trading 0 days to expiration. You don't have to worry about, hey, I got to close my position at 3:59 before the close to avoid assignment or exercise or any of those types of issues. You also have tax favorable treatment when you're trading index options. There's the Section 1256 contract. That means 60% of it is taxed at long-term capital gains, 40% at short-term capital gains. If you're trading in a taxable account, so they are tax favored from that perspective. So comparing it apples to apples, if you're trading the same size, index options provides kind of favorable tax treatment. Cash settlement, they're European, which means that you don't have early assignment, even though that's usually not that big of an issue with 0 days to expiration. There are some complexities in terms of monthly options or AM settled, so you generally want to avoid trading those. Most of them, in terms of dailies are PM settled, so those are predominantly what you'll be trading. And each contract refers to typically 100 times the index level. Now, my only concern with these types of products for most retail traders is simply their size. SPX is over a $500,000 contract, and NDX NASDAQ 100 is a $1.8 million notional contract. Sometimes that's out of the range for a lot of retail traders. So that's really the biggest issue with these types of index options. Now, both SPX and NDX do offer micro and mini and nano type contracts for index options, but it's important to understand that they're not as liquid. So you can't expect the same amount of liquidity as you would trading SPX or even SPY or QQQ. And that's why we want to look at ETF options for some traders in this particular space. If you're trading with an account under $50,000, you generally want to look at SPY and QQQ because they provide the same liquidity and depth as SPX and NDX, but they're simply better suited for smaller account sizes. They are for physical delivery, so there is exercise and assignment risk. So you generally have to be aware of that and close out your positions before the close if you want to avoid those risks. They are all PM settled, so they're easy to kind of manage from that perspective, and they all 100 shares multiplier on the premiums. So you kind of get many of the same benefits, if you will, at a small, you get the liquidity benefits at a smaller size. So you kind of have to ask yourself as to what makes sense for you as regards to the products. But like I said, if you have a larger account, index options is a way to go. Smaller account, you kind of have to weigh your pros and cons as to whether you choose to trade one of the mini or micro index options that are not as liquid, or trade an ETF options that's far more liquid. From my perspective, if you have a small account, stick to the ETFs just because of the liquidity. That matters more, in my opinion, than cash settlement and avoiding physical delivery, since if you can manage because those are risks that you can manage, but liquidity is something that you can't really manage. So smaller accounts go for ETFs, larger accounts use those index options. Does that make sense to everyone? Please type 4 into the chat window if that makes sense to you. Perfect. Okay. Now we've kind of set the ground rules for understanding 0 days to expiration, what products to trade. Let's now talk a little bit about actually trading these, because trading 0 days to expiration requires a completely different mentality for trading. And, this is actually kind of where I started trading. I started trading futures as a day trader 18 years ago. And the mentality to trade intraday is a very, very different mentality than swing trading, or if you're trading options, longer dated options, where you can kind of look at your account, a couple of times a day, maybe even some days you don't look at it at all. When you're trading 0 days to expiration, you really have to remain pretty glued to the screen. You typically will need multiple monitors to track, quite a few different things in real time. But it's important to understand statistics, and because day trading requires kind of a very disciplined strategy and a methodical, systematic strategy that you follow day in and day out. And there are many days that are just there's not a lot of action, and you have to be okay with that. Even though you're sitting in front of a screen for 4 or 5 hours, you could be sitting there for hours not really doing much other than maybe staying in a position or just waiting for a position. So it is a complete different shift in mentality. And if you've never done it before, meaning if you're a swing trader, if you're a long-term investor and you want to trade these 0 days to expiration, it really takes a bit of time to adjust to the mentality that a day trader has, sitting in front of that screen, being disciplined and sitting there for hours waiting for a trade. Because a lot of times, especially for people who start out with day trading for the first time, they sit there for 30 minutes. They can't help themselves. They just have to get into a trade. And what you end up doing is you force trades that aren't there. And that's human nature. So this is the first thing that you really have to adapt to. And one of the things that we want to kind of understand a little bit is statistics, right? Most days will lack a strong direction. Look at a day like today. Markets really didn't go anywhere. We opened higher and it just stuck there in a range. That's what majority of days look like in terms of trading. And on those types of days, you generally want to favor option selling strategies. We'll talk about what type of selling strategies you can deploy, simple ones and advanced ones here in a second. But it's important to understand that the majority of your days will be like a day like today, really boring, and what you're doing is you're collecting income. Only about 15 to 20% of the days have what we call a really strong trend. And when we talk about like having all the indicators aligned from a market breadth perspective, you're probably looking at only about 5% of the days where you're trading a strong directional trade. So it's really important to understand that the vast majority of days you're likely going to be an option seller. It's kind of boring. You're collecting premium and you're trying to do it day in and day out. And then once in a while, about 5 to 10% of the days, you get these big, strong moves to the upside. And that is your opportunity to pull the trigger and trade, some home runs. And 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 you have to be prepared mentally for that. I don't know how else to explain it to you other than actually going about doing it and sitting in front of those screens, and getting a feel for what it feels like to sit there all day long and really not do a whole lot for a lot of the day. And then once in a while, you get this action that you really have to jump on. You got to be mentally clear for when that happens as to what to do. And hopefully we'll help you set some of the foundations for that. The second thing is as an intraday trader is that you look at completely different sets of indicators. Now, there are certain indicators that we as swing traders don't even ever bother looking at because they don't really matter to us over a higher time frame. But as a day trader, things like the advanced decline line is incredibly important to help us understand on a single day how many advancing stocks are there versus declining stocks, and kind of that ratio is really helpful in understanding the strength of the day. Tick and trend is another thing that the exchanges publish. These are all indicators that are published by the exchange, by the way. NYSE publishes it, SPX, SIBO publishes it for SPX. And these are all ones that you can subscribe through your broker's platform. Tick and trend, just simply calculating the number of stocks that are ticking up versus the stocks that are ticking down at any one moment. And it's a very, very chaotic indicator, but it gives you a good sense for who's in control at that very moment, buyers or sellers. And looking at that gives you who might be in control for that day, buyers or sellers. Looking at the percentage of volume of up versus down. These are all indicators that are, like I said, published by the exchanges, that day traders kind of stay glued on every single day. But as swing traders, we don't look at because they're not really useful. They're only useful within one trading session. So you have to adapt to learning a whole new set of indicators if you want to trade intraday. These are the types of things that I used to look at on my screens. And this is part of why a lot of day traders have multiple monitors, because these are things that they kind of have to have up all the time on top of their trading screens. So you might have your charts for the underlying index, then you have these market breadth indicators, then you might have some watch lists to help you understand, what's moving, whether we have a risk on or risk off day, and then you have your options chain. You really kind of have to have these things all ready to go at once. You don't want to be fumbling through multiple tabs to kind of get access to these types of information. You kind of want to have all of these things all at once, which is why, when I was day trading, I had 4 monitors on my desktop just to keep tap of everything in terms of trading. But very different mentality. And probably the most difficult thing about trading intraday is the ability to stay disciplined in this type of environment, because a lot of days when you're sitting around not doing much and you're just collecting, what feels like a few bucks every hour. You're itching to trade. You see other things are moving, you see stocks that are moving, but you kind of have to stay disciplined to this type of strategy. And a lot of times traders, what they'll do is they'll force trades that are not there. And that's really kind of where a lot of day traders tend to go south with their trading, is they force trades and they're not disciplined in their strategies. So what you're doing is you have to sell options most days and be ready to pull the trigger on these big trends, but understand the statistics of, 80, 85% of days, you're really not going to get much in terms of a big move. It doesn't make sense to be buying options. 5 to 10% of the time, it does make that big move. Your indicators will tell you that, and you got to be able to pull the trigger on that. So if that makes sense, everyone, please type 5 into the chat window if that makes sense to you. Perfect. Okay, so let's talk about the first option selling strategy. This is the 0 days expiration credit spread. This is probably the most popular, the most commonly traded strategy for 0 days expiration. Now, obviously with credit spreads, you can sell a bullish credit spread, you can sell a bullish credit spread, or you can sell a bearish credit spread. And from our back testing, it clearly shows that it only favors to be selling bull put spreads as a credit spread on 0 days to expiration. Selling 0 days to expiration call spreads in the long run as a systematic strategy is actually a negative return strategy, which is why, generally speaking, iron contours is not a strategy that's typically used for 0 days to expiration because the call side always underperforms. You can make adjustments, meaning you can always tilt it so that you have the call options that are out of the money, but even then we tend to find that those have negative returns in the long run. So that's why we don't trade both sides of the iron condor. We only trade the put side, which is the put credit spread. Statistics simply favor bullish strategies as a systematic strategy. So very, very simple strategy to do. And generally speaking, when we talk about selling bull put spreads on index options or ETF options, we're looking at basically selling a slightly out of the money call put and then buying back an out of the money put, about a 20 delta. So we'll sell the 40 delta, buy about a 20 delta. Typically, this is going to be about a $2 to $3 wide on SPY or about $20 to $30 wide on SPX because SPX is roughly 10 times SPY. So, that means you're selling credit spreads that are usually $2 to $3 wide. You're collecting anywhere, we try to collect as close to 33% of the vertical width as possible, but typically what you're going to come out with is collecting about 25% of the vertical width. That's just all you're going to get on these index options or indices. You're just not going to collect 33% of the width or 40% of the width like you do in single stock. You just don't have the skew dynamics in index options. Very, very rarely you're going to get close to 33%. Most of the time, you're going to get about 25% of the vertical width. Now, with this type of strategy, the goal is simply to hold it to expiration. Because the strategy has defined risk, there's really no benefit to managing losses. Some people will say, oh, if I lose 100% of the premium or 200% of the premium, let me cut my losers instead of losing the full 3-to-1. But we tend to find that in the long run, managing losers actually does not do anything in terms of performance or help your probability of profit in the long run. So with this type of strategy, you basically put on, especially we didn't get enough time to actually dive into the details of the technical indicators that we'll talk about here today. So if you guys are interested in kind of diving into the internal metrics for analyzing an intraday move, we can certainly do a separate webinar on that if many of you are interested in that. But on days where the market doesn't have a strong move and the market indicators are telling you there is, buyers or sellers don't, one or the other doesn't have full control of the markets, this is the type of strategy you want to deploy. This is what you're going to deploy vast majority of days when you're selling 0 days to expiration, is selling bull put spreads over and over again, collecting a premium and holding them to expiration. You don't really have to manage these trades, but if you're doing it on SPY or QQQ, you do have to be aware of assignment risk, right? So if it drops below your short strike price, you do want to close this, before expiration to avoid being assigned on it. But otherwise, these are the type of strategies that you're holding to expiration. If you're having index options, you can just hold them into expiration and you can leave them there. But the goal here is to have a fairly passive strategy where you kind of, as long as the market is moving sideways, and you can see in the first hour that buyers or sellers, are fair equilibrium, one or the other doesn't have full control of the market. That's really when you want to pull the trigger on these. Usually you can trade these by about 10:30 a.m. and be pretty confident that you have a good sense for the trends of the day before you trade one of these types of strategies. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Sure, I saw a few comments about asking for some of those technical indicators for intraday. We'll certainly look at doing one of those as well. But this is what the vast majority of your day is going to look. A vast majority of your days, if you're selling 0 days to expiration options, will look like are selling these types of simple credit spreads. So looking at SPY today, we closed at about 522. What we're going to look at is basically selling a 522, 520 put vertical expiring tomorrow. As of right now, this is a $2 wide credit spread. As you can see, I'm collecting 53 cents. That gives me a risk reward ratio, like I said, of about 3 to 1. This is probably the most typical type of strategy that you would trade on this type of kind of directionless day like we saw here today. You would have opened up the trade this morning by about 10:30 a.m. You would have seen that the buyers nor sellers really had control of the markets. Actually, this morning you did have buyers have control, but they kind of lost that by about 10:30, 11 o'clock. And that's kind of a signal that you can start putting on some of these types of spreads, and you're effectively trying to hold them to expiration. Not a whole lot to do. You don't have to really manage these, certainly not for a profit or a loss, because they have defined risk. You can basically hold them into expiration. Okay, so next strategy, really for the few percentage of days when you do get a strong move. And this is really where pretty much by like 9:45, 10 a.m., you have a pretty good sense that buyers or sellers is in control for the day and they're maintaining control. We see it on the market breadth indicators. You see the number of advanced versus declines. It usually tends to have 1,500, 2,000 stocks that are advancing, or 1,500, 2,000 stocks that are declining, and they're kind of staying there. If you look at tick, you see kind of pretty much it's always ticking upwards or always ticking downwards. You look at the amount of volume, the ratio of up versus down volume, it's kind of very extreme. Like I said, only about 5% of days, 10% of the days, you're going to have this type of action. And you can identify that usually by about 9:45, 10 a.m. If you can be conservative and wait till 10:30-ish to really get a sense for if buyers or sellers are maintaining control for that day. For example, I've seen in the morning, buyers had control, but they kind of lost it by about 10:30 or so. And at that point, you would have said, we're not getting that direction move. And certainly the price action in the first hour were very choppy. We just didn't go anywhere. And that was another signal that we weren't going to get this big trending day. But on big trending days, what you basically do is you basically open at the lows and close at the highs, or open at the highs and close at the lows. And it basically goes in one direction the whole day. We've all seen it in terms of when we're trading, what types of days they are. They don't happen very often, but on those days, those are the days that you want to buy a call or buy a put. And specifically what you're buying is an out of the money call or an out of the money put. This is generally speaking, what you're doing is you're buying a 30 delta call. Typically, this will cost about $1 on SPY or about $10 on SPX. Just as a general rule of thumb, you're paying about $1 for these types of options, and what you're looking for is a big move that will continue into the expiration or into the decline. These strong momentum days tend to close at the highs or at the lows of the day. So these are also the types of strategies that you typically will hold into expiration. So for example, with SPY currently trading at 522, if let's say you were trading this type of strategy tomorrow, and let's say we get a really strong up day, you might look at buying, in this particular case, I was looking at the 524s, which was a 32 delta for tomorrow, right? So we're looking at about that 30 delta strike price, and we're looking to buy that at the time. Right now, this is actually only 61 cents. VIX is obviously very low, so the premiums are quite inexpensive to buy these out of the money call options. And what you're looking for is maybe a $3-4 move in SPY, and that's what's going to give you kind of that 61-cent option turning into a $3 option by expiration. And you could be looking at a 400, 500, 600% return on your call option. Not often that does this happen, but when they do, this is really where you want to be positioned to hit home runs, right? You don't want to be collecting $53 in income per contract. You want to try to turn your $61 into into $400 per contract. So you have to have your indicators set up ready to go and to identify these types of setups. You can do it through price action, but it's better to kind of have confirmation using these market breadth indicators to get a sense for if buyers or sellers have control for the day and maintaining that control. But if they do, usually by 10:30, you have a pretty good sense that, hey, buyers are maintaining control. Price action is continuing to move higher here. Let's pull the trigger and buy one of these out of the money options. And even by 10:30 a.m., it's not too late to pull the trigger on some of these, because a lot of times on these strong momentum days, you get that, 1.5% move to the upside, and it just happens all day long. Doesn't happen very often, but when it does, you want to make sure that you're positioned correctly. But vast majority of days, you are not going to use this strategy. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, the last strategy we're going to talk about is kind of the deep end of the pool. But for those of you that have a good foundational understanding of option strategies, this one should not scare you. It sounds complicated, and it sort of is complicated to some degree. It's called a straddle strangle swap. Basically, what you're doing is you're basically trading a straddle and a strangle at multiple time frames. You can also think of it as a double diagonal, or you can think about it as a put diagonal and a call diagonal at once. There's multiple ways to slice and dice it, but it's called a straddle swap, which is a mouthful. It's really a fairly neutral vol strategy. It's a advanced strategy that's basically trading volatility arbitrage between the very short dated options and the longer dated options. You're basically selling something with high vol and buying something with low vol, and basically being fairly delta neutral so that you don't have much exposure to the movements of the underlying security. You're basically shorting high vol and buying long vol, and kind of capturing the difference between the two. Again, like I said, sounds complicated, but let me help you break it down. What you're doing here is you're buying a 30 days to expiration. So you're buying a 20 delta strangle. So you're buying an out of the money strangle that's 30 days out. That kind of gives you, some directional exposure, or it's fairly delta neutral because you're buying 20 deltas. And then what you're doing is you're selling an at the money straddle. And the strategy driver here is actually selling that at the money straddle. Selling an at the money straddle is the purest way to collect income on an index option, 0 days to expiration. That's really taking advantage of that acceleration in time decay that I was talking about in that first slide, right? By selling a 0 days to expiration at the money straddle, you are collecting as much income as possible. And I'm going to show you how much income that you're collecting. But when you're selling an at the money straddle, that has unlimited risk, right? Granted, how much can an index move in a single day? There's a limit as to, generally speaking, how much an index can move in a given day. But you still technically have unlimited risk. It takes a fair amount of capital if you were to sell that at the money straddle naked, but it is overall one of the most profitable strategies of just selling a naked at the money 0 days to expiration straddle in the long run. But because most traders don't want to take on the unlimited risk, most traders don't want to have to put up the capital to trade a naked at the money straddle. So what you do is you basically buy this 30-day at the 20 delta strangle, because that's going to provide kind of that offset in terms of margin requirements, and offsets the delta risk as well. And because it's 30 days and it's 20 deltas, the cost to it is very close to the premium that you collect on that at the money straddle. And this is, like I said, the strategy driver is the at the money straddle. And what you're trying to do is potentially sell multiple straddles throughout the day. You sell the straddle starting at 9:30 in the morning. And what you're trying to do is, as soon as you collect 25% of the max gain of that straddle, you take profits on it. And what you do is you try to do it again. Meaning if the markets have drifted, $1 higher, you basically recenter your at the money straddle and sell another at the money straddle. And you keep holding it either to expiration, or you do it where you collect 25% of the max profits and you take profits. If it turns to a loss, you just hold it through expiration. You don't have to manage losers, you only have to manage winners. And the key here is that you must close out both the short straddle and the long strangle at the end of every single day. And what you do is basically every single day you roll forward your straddle swap. Like I said, this is a advanced strategy, but for those of you that have a foundational knowledge of option strategies, this is kind of the deep end of the pool, but this is one of the more profitable strategies of selling 0 days expiration. But let me just walk you through a real example because that's going to help you better understand this. So I have this straddle swap set up. So what we're doing is we're selling an at-the-money straddle. So for example, for tomorrow, because we're trading at 522.20, let's actually move this down to the 522s just for arguments, just to be clear here. And as you can see, by selling the 522 straddle, here I'm collecting $1.57 on the calls and then 92 cents on the put. So I'm collecting roughly $2.50 in a single day by selling the at-the-money straddle. But like I said, when I sell the at-the-money straddle, I have unlimited risk, and it requires a lot of capital in order to trade this. So what I'm going to do is I'm going to buy basically the 30-day out of the money strangle, and that's going to cost me in this particular case about $3.60, $3.70 or so. So not much more premium than I'm collecting. And remember, that's 30 days out, right? And what it does is it basically reduces the amount of capital that's required to put up this trade. I only need about $2,000 in margin to trade this particular strategy. And the goal here is to try to collect that roughly $2.50. So think about it. If I can end up collecting $2.50 on that day while posting only $2,000 in margin, that's over 10% yield in a single day, right? You might not do that every single day, but what you're trying to do is basically, if let's say you sell this 522 straddle, and by 11 a.m., you've already collected 25% of the $2.50. What you do is you basically take profits on that straddle, and what you do is you try to sell a new straddle. Maybe the stock, maybe SPY has drifted up to 521 or drifted down to 521 or up to 523. What you basically do is you recenter that straddle and you sell it again, and you try to collect more premium. And you keep doing that every single time. You either take profits at 25% of max gain, or you just hold it through expiration. That's it. Those are your only two things. So it's actually fairly easy in terms of maintaining. It is a little bit more complicated because you have to take profits on your straddles, and you must close out both legs, both the straddle and the strangle at the end of each day, and reestablish it the next day. You don't want to hold on to the strangle overnight because you do have time decay working against you on the long strangle. You don't want to hold it overnight. So what you basically is close out the strangle overnight, and the next day you establish a new 30-day strangle in addition to selling the at-the-money straddle. Hi, Maxie. Sorry, my 2-year-old just ran into the room. Hey, I'm on a call, okay? So I'm gonna stay on my call. Hey. All right, guys, that was my 2-year-old that decided to make an impromptu. So in terms of the strategy, what you're doing is you're selling the at-the-money straddle. You're selling at the money straddle. So whatever the current price is, that's the straddle that you sell. And what you're buying is a 20 delta strangle in addition to that. And the strangle basically just offsets the overall risk that you have on the short straddle. And it also significantly reduces the amount of margin requirements from tens of thousands, probably $10,000 that you need in margin requirement to sell an at the money straddle on SPY versus the roughly $2,000 in margin that's required to trade a strangle swap. So you're reducing your margin requirements by about 80%, which is going to simply increase your overall return on the strategy. So, you might not collect $2.50 a day on this type of strategy. Maybe you only collect $1.50, but think about $1.50 on 20 effectively what is $20 worth of margin that you have to put up on that. That's a pretty substantial yield in a single day. And your delta exposure here is fairly neutral, and because the strangle kind of offsets some of the delta exposure that you have on that short straddle. Like I said, that's the deep end of the pool. But those are three of the most popular option strategies for traders. Like I said, the credit spread is kind of your go-to if you're starting out with option selling for 0 days to expiration. It's a pretty simple strategy. The rules are pretty mechanical, and you're always selling the put side, so you don't have to worry so much about direction. For those of you that have a little bit more experience, the Strangle swap is really something that you might want to start exploring, because that's going to help you significantly increase the amount of premium that you can collect from 0 days to expiration, and really capture that acceleration in time decay by selling that at the money straddle without all the unlimited risk and without the margin requirements to actually sell an at the money strangle. And then for the few days that you get that big directional move, also pretty simple, out of the money call option, out of the money put option. You buy it and you hold it to their expiration, and you're looking for that big move here to the upside. Some days you don't get it, but on the few days that you do, you do see 3, 4, 5, 600% returns on those calls or puts on that single given day. And those are the days that you want to make sure that you are ready to pull the trigger on these types of strategies. With that, that covers what I wanted to share with you here today. Hopefully, just a quick review of what we learned here today. First of all, remember, gamma and theta are the two most important Greeks to understand if you're trading 0 days to expiration. So if you're not familiar with that, make sure you brush up on your Greeks of gamma and theta. Understand how much income you are collecting on a 0 days to expiration versus longer dated options. Understand how much leverage you're getting for these types of strategies. Leverage obviously works in both ways, if it could work against you or in your favor. So understand that before you trade this. We talked about the 3 you can use for 0 days of expiration, and we talked about the best practices for each one of these strategies. So hopefully this gives you a quick review of that. Like I said, you can use these slides as kind of your cheat sheet. I went through a lot of details of each of these strategies. Make sure that you take the time and learn more about this, especially if you're new to these types of strategies. But I gave you the rules for entry, the rules for exit, whether you hold them to expiration, when you might want to take profit or losses. And hopefully the examples here today give you a good sense for how to deploy these strategies in your trading account. But like I said, this is just the foundational introduction to 0 days to expiration. If you guys want more of this, if you want me to get deep into any one of these strategies, let us know. We will certainly do that for you guys in the future. We'll certainly do one on the technical analysis side of things, because that is a completely new beast that many of you, if you've never day traded before, you have probably never even heard of some of these indicators that I'm speaking about here today. Otherwise, if you want to find out more about these strategies, we can also do a little bit more of an advanced, more in-depth strategy here as well. So with that, let's turn this over to our Q&A. But before I do, just a reminder for those of you that are looking at access to both the recording and the slides. Like I said, the slides are really your cheat sheet for these types of strategies. So make sure you get access to these slides. You can get them either by signing up to your you can either sign up to your free 30-day trial to OptionsPlay. Sorry, I lost my train of thought there for 1 second. By either pointing your phone to the QR code on your screen or go to optionsplay.com/sign up. That will give you access to the OptionsPlay platform that you can model some of these strategies and see them as to how the P&Ls and the risk to reward ratios of these types of strategies. They'll also give you access to the recording and slides for today's session. So let's open this up for Q&A. There's a chat window and the Q&A window. Please type your questions into the Q&A window, and I'll try to answer as many questions as I have time for here today. How can you actually lose money with this strategy? With all of these strategies, you can lose money. What we're trying to do is help you have defined risk. All 3 strategies that we discussed here today have defined risk. So you know risk you can potentially have, and you have to size it accordingly, meaning trade the appropriate number of contracts for your account size. Where are 0 days to expiration options available? Anywhere you trade options, they're available. Every broker that trades options will have them available. Can you say the best ETF for 0 days to expiration? SPY and QQQ. By far, those are the two best ETFs for trading index options, for trading ETF options. In terms of micro index options, it's just XSP and XND. Those are the only two. I don't think there's any other ones worth even looking at. I don't even think there are many other ones that are available. I'm not necessarily implying that under 50K is a small account. I'm saying under 50K, you can't trade SPX or NDX because SPX is a $500,000 contract and NDX is a $1.8 million contract. So $50,000, in my opinion, is the minimum threshold to trade some of those larger contract sizes. And arguably 50,000 is not enough to trade NDX. You probably need $100,000 and $150,000 to trade NDX. Can you list all the indicators used for 0 days to expiration trading? I have it listed here. Advanced decline line, the number of advancing stocks versus number of declining stocks. Tick and trend, meaning which is literally on this very tick, how many stocks are ticking up versus ticking down, up versus down volume. You can look at that from a ratio perspective, meaning what percentage of volume is up volume, what percentage of volume is down volume, and what you're looking for on all of these are extremes. That gives you a good sense that buyers are in control for today, or sellers are in control for today, or no one's really in control for that day. And like I said, vast majority of days it oscillates between buyers and sellers, and those are the days that you want to be selling options. Other times, basically, the market opens and you can clearly see buyers have control or sellers have control, and they basically maintain control for the first hour or so. That gives you a pretty good indication that they will likely maintain control for the rest of the day. It doesn't mean that they will maintain control for the rest of the day. Like today, we actually saw buyers right on the open maintain control for nearly an hour and then lost it. But even if you looked at price action, even though they had control, they couldn't get anywhere. So from that perspective, that gives you a good sense that today is not the type of day to trade the buying out of the money call options. But those are generally the indicators that we use. Can you explain iron fly on 0 days expiration? Iron fly is basically a similar strategy to this, but instead of buying a 30-day strangle, where you're basically buying is a single day, is the same day strangle, right? That turns into an iron butterfly. So in conception, it's the same type of strategy. And you can trade this type of strategy as well. But the only thing is that with this type of strategy, your margin requirements are very similar, right? So for example, let's say your max risk here is $1,300. So that's your margin requirements, $1,300 to trade an iron fly. And iron flies are very similar to what I just said in terms of a strangled swap, and probably a more beginner type version of it. And it's absolutely a strategy that you can start with as opposed to a strangle swap. When does one set stops on a 0 days expiration? So all the strategies that we discussed are defined risk. And with these types of defined risk strategies, we tend to find that you should not put stops on them. We tend to find that stops actually underperform or actually don't improve the performance of this strategy in the long run. So for those reasons, we don't look at putting stops on these types of strategies. You already know how much you're going to risk on these types of strategies. Just trade the appropriate number of contracts and you don't need the stops on them because the strategies themselves effectively act as your stop. And every single day you trade a 0 days expiration, you should be fully comfortable with potentially losing the max risk of that day, right? So whatever the number of contracts you trade, what the max risk is, you should be comfortable with losing that at the end of the day. If you're not comfortable with that, you're trading too big of a size. How does the Fed day affect the strategy? It absolutely does. Like yesterday, no one had control until 2 p.m. All of a sudden, buyers had control, right? And the markets took off. So that doesn't happen because most type of events like that don't happen intraday. Most of those things, like for example, macroeconomic events come out at 8:30 in the morning. So basically, by the open, you already kind of see who's established control. But those are the days that you generally want to be aware of, and maybe not be an option seller on the wrong side of things, maybe close out by 2 p.m., see how the market goes, and maybe establish a new trade after the Fed announcement comes out, unless you're trying to bet on the directional move. But generally speaking, you want to avoid being a seller of options going into a catalyst event like that. Might we do this on an individual name on a Friday? If you're trading the major names like Apple, Google, Tesla, right? The Magnificent Seven, that basically are the market. Yes, you can do that. The short answer to your question is yes, if you stick to those very, very liquid names. How do you close out a strangle swap, a straddle swap, if rolling forward to the next day? You basically close out all legs by 359. That's it. You close out all legs by the open, and the next day you basically recenter everything. So next day you determine what the 20 deltas are for the strangle and what the at the money is, and you reestablish every trade at 9:30 in the morning. You just don't hold the strangle overnight. Another strategy is you basically hold the strangle overnight, and you come back and you sell new straddles throughout the next day. But the premium that you lose on the strangle each day you hold on to it overnight basically makes the strategy underperform in the long run. So basically it's better off, especially when you're trading these super liquid names where you can basically close out the strangle for virtually zero transaction costs. That's where it does make sense to do that. Why 30 days for protection? It's really just to reduce the cost, right? When you go out 30 days, the cost of that strangle is virtually the same premium as you're collecting. So you're not paying anything in terms of the debit to get into the trade. So going out 30 days basically allows you to do it at basically a zero cost, if you will, on that trade. Peter, questions about the recording. We post the recordings onto YouTube. We usually go every single Sunday is when we post these on YouTube. So this Sunday, you will see the recording of this go live on our YouTube channel. For the straddle strangle strategy during the day, you only close the straddle and you keep the strangle the same. Yes, that's correct. You don't touch the strangle intraday. You only potentially take profits on the straddle and sell a new straddle. And if the straddle has not reached 25% of the max gain, you basically just hold it through expiration and close it at the end of the day. How can a strangle swap go wrong and how do you fix it? The most wrong it can go is that at the end of the day, the short straddle has lost money and you close it at the end of the day. That's it. That's the most it can go wrong. Then you reestablish it again tomorrow, right? You basically try to collect the $2.50 tomorrow, right? So maybe today market moves substantially against you and you lose $2.50 on the short straddle, right? And that's it. You make a little bit of money on the long strangle, you lose $2.50 on the short straddle, and you come back tomorrow, and you try to collect another $2.50 in your straddle. That's it. It kind of resets every single day, even though technically it looks like it's a long-term trade. Can we sell the 0 days expiration by the weekly? You can. You absolutely can do the weeklies as well. Do the margin requirements you mentioned apply to IRAs? They apply to all accounts. Margin requirements don't change depending on the type of account that you have. Strangle swaps is for days where indices will likely be sideways and neutral, correct? It definitely is for the days when it's sideways. And yes, generally speaking, on days where you can clearly see by 9:45, 10 a.m. that the buyers have control or sellers have control and they aren't letting up, probably not the best day to be trading the strangle swap. Those are for kind of more neutral days. Do you already have videos on straddles and strangles? Yes, if you go on our YouTube channel, we do have videos just on straddles and strangles. The straddle strangle is not necessarily traded as a credit. It's many times actually traded as a small debit. With SPX, you say you can let your credit spreads expire as they are defined risks. Is that okay with in the money and out of the money credit spreads? So all index options like SPX, they're all cash settled, right? So when we say you can hold it to expiration, we're talking about because of the fact the cash settled. There's nothing to do with the fact that whether they're in the money or out of the money, or the fact that they're defined risk. Because index options, whatever P&L you have, it's just deposited in your account. There's no physical delivery. How do you find the optimal entry point? So, with these types of strategies, with these types of indicators, you have a pretty good sense by about 9:45 and 10 a.m., what type of day it is. That's kind of the more aggressive entry. For those of you that want to be a little bit more conservative, you want to wait till about 10:30. You will get a pretty good sense by that, whether or not, anyone, buyers or sellers have control. And that's kind of when you can decide a lower risk entry for that. But usually by 10 a.m. is kind of the more aggressive entry. 10:30, 10:45 is the more conservative entry for this. But you generally want to be in the markets by about 10:45, 10:30, 10:45. Under which conditions would you not open the swap trade? Just when you clearly see that one side of the market clearly has control, you generally don't want to trade that swap strategy. You just want to buy that call option or buy that put option. Okay, with that covers what I wanted to cover with you here today. I hope this is helpful in giving you a better understanding of some foundational knowledge for trading 0 days to expiration. Based on kind of the turnout here today, it sounds like we'll want to do more. So we'll cover a little bit more about trading 0 days to expiration next week. Maybe we'll get through some of the indicators, some of the technical indicators next week. But please let us know what you think. Give us your feedback, and we'll continue to do more and more of this to help you gain more knowledge for trading options. With that, thank you so much. Have a great trading day, and I'll see you guys here next week.